Okay, risk premiums and risk aversion. So we talked about the risk-free rate, the rate of return that can be earned with certainty. We usually assume that the T-bill rate is the risk-free rate, so readily available and easy to access. So the risk premium is the expected return in excess of that on risk-free securities. So think of it as your reward for taking risk. So, the rate of excess return is simply the rate of return in excess of the risk-free rate. Risk aversion is a reluctance to accept risk. So, we typically can assume that most investors are risk averse. There are certainly examples of individuals who are not. Probably the most widely used example is the example of purchasing a lottery ticket because of the likelihood of winning is so low. Price of risk is the ratio of the risk premium to the variance. So we'll talk about that more as we move forward. So the Sharpe ratio. The Sharpe ratio is also referred to as a reward to volatility ratio. Think of it as a risk-adjusted return, a measure of risk-adjusted return. So the ratio of portfolio risk premium to standard deviation. So, and mean variance analysis, ranking the portfolios by Sharpe ratios. So we can compare different portfolios, and we're going to do so in some examples moving forward here. And what we're going to do is we're going to take the portfolio's risk premium and divide that by the standard deviation of excess returns. So it's expected return on the portfolio minus the risk-free rate divided by the standard deviation of the portfolio. So table 5.5 shows the excess returns on market index for and shows the average, the standard deviation, and the Sharpe ratio. So the average excess return for market index 8.48% from 1926 to 27. Standard deviation of just over 20% represents a Sharpe ratio of 0.42. Then from 1927 to 1956, we had an average of 11.22, much higher standard deviation of almost 25%, represents a Sharpe ratio of 0.45. We can see 57 to 87, the excess returns were lower. Standard deviation was also lower. The Sharpe ratio, as a result, was much lower, 0.31. In 1988 to 2016, at 8.88 excess return, 17.69 standard deviation, or the 0.5 Sharpe ratio. So even higher Sharpe ratio than any of the previous periods shown here. So anytime you're selecting an investment, you're going to prefer the investment that offers the higher Sharpe ratio. It indicates that investment has a higher reward to volatility ratio. The historical record, this is world portfolios. We've got world large stocks. That's stocks, 6,000 stocks for 24 developed countries. U.S. large cap is standard S&P 500. So that's the 500 largest capitalized stocks in the U.S. U.S. small stocks is the smallest 20% on NYSE, NASDAQ, and Amex. World bonds, same countries as world large stocks. So, Treasury bonds is Barclays long-term Treasury bond index. One thing of note, Barclays took over the Treasury bond index from Lehman Brothers. they took over after Lehman failed. Barclays took over much of Lehman's operations, and they inherited that index. The so the risk and return on investments for major asset classes. Get the for table 5.3 here. The average for T-bills 3.42%. No risk premium there. So this is our risk-free asset. Treasury bonds, the arithmetic average of 5.5%. Risk premium 2.08. That's just simply the 5.51 minus the 3.42. We go over the stocks. The average 11.91%. The risk premium 8.48. You can see the standard deviation goes up considerably as we go from T-bills to Treasury bonds to stocks. We have max on T-bills of 14.71, a minimum of these are returns. Then we look at Treasury bonds, 38%, and a loss of almost 8.5%. Then we get to stocks, highest gain 56.38%, highest loss 43.73%. So some significant differences there. You can see as you move into from Treasury bills to equity, the risk and increases significantly. However, the return increases significantly. This is the historic returns for Treasury bills over that time period. We can see that the vast majority were 0 to 5%. We had some return, 20% of just over 20% of the return is 5 to 10%. Zero losses over here looks like less than 5%, and then 10 to 15%, somewhere in the neighborhood of 4 or 5% maybe. Then when we switch to bonds, we see something that looks a little more like a normal distribution. So, but again, the vast majority of the Treasury bond returns 0 to 5% 0 to 5% range, there is some skew to these returns. So there's what we might refer to as a fatter tail on this side. This certainly is not a perfectly normal distribution. And then when we look at the equities, this distribution doesn't look anything like a normal distribution. So we do have some very fat tails, and our returns are certainly concentrated in the middle, but again, that's not necessarily a normal anything close to a normal return.